Greetings and welcome back to the lesson. The subject is financial management. Today we are going to study a subtopic under the topic personal financial management, known as personal risk management. Personal risk management. In this lesson, by the end of the lesson, you should be able to define personal risk management, be able to identify some of the key aspects of personal risk management and the benefits of personal risk management. First of all, let's define personal risk management. Now, candidates, personal risk management is a process of identifying, assessing, and prioritizing potential risks that individuals may face in their personal lives. It is a process of identifying. You identify the potential risks, you assess the potential risks, and prioritize the potential risks that an individual may face in their personal lives. After having done that, then one has to take measures to mitigate those risks. And this process involves a systematic approach to understanding and addressing the uncertainties and the potential negative events that could impact an individual's well-being, that may also affect an individual's financial stability, health, and the overall quality of life. Candidates, as individuals, as human beings, we go through various events that can threaten our financial stability, that can threaten our very survival, that can threaten or endanger the quality of the life that we live. So it's important as an individual to carry out what we call personal risk management. Just the same way companies carry out risk management, as an individual, one has to systematically assess, identify, and prioritize potential risks that can affect one's overall quality of life. And candidates' personal risk management is essentially the art of proactively minimizing the potential impact of unseen events in one's life. It's about taking control. It's about preparing for the uncertainties that may come your way, so that one does not just live as though uncertainties can come your way. Chances that one can be sick are there. There is also probability that one may lose a job. It's possible that one can undergo different situations that can negatively impact the quality of life of a person. It is possible that the person you are depending on can die. It's possible that one can lose a job. It's possible that one can have disability. One can be sick. One can be engaged in an accident. It's a probability that your property can be damaged. Your house can be broken down. Your house can be destroyed completely. So these are some of the potential risks we are talking about. And as an individual, it's important to assess, to identify such risks and put in place measures to mitigate against such risks. So personal risk management involves identifying such risks and recognizing all the potential threats to your well-being, to your finances, to your health and lifestyle. Think of illness, think of disability, think of unemployment, think of accidents, think of property damages, and so on. So that is identifying risks. So you first of all identify. These are key aspects. Key aspects. Risk identification. I've given examples of such risks. Then to measuring the risks. Measure risks. All right? You assess the likelihood and the potential of each risk, which will help you now prioritize your focus. Measuring the risks. Then treating risks. This may involve, again, treating the risks. This means putting in place mitigation measures. You choose strategies to mitigate the negative impact of the identified risks. And some common methods or strategies could be avoiding the risk. By avoiding, I mean minimize exposure to certain activities or situations that can give rise to occurrence of the risk. Another strategy is to reducing the risk. That means lowering the potential impact, perhaps through safety measures or lifestyle changes. If, for example, you are a heavy smoker, you can stop smoking, because we know heavy smoking can endanger one's health. So you can reduce the potential impact of smoking on your life. Or you could be engaged in jobs that are too risky. There are certain jobs that can endanger one's life, so you can minimize your exposure to such environments. Another way could be transferring the risk. You can share that risk with other parties, like insurance companies, through financial products and so on. Transfer the risk. Yet another strategy or method is retaining the risk. That means accepting the risk and its potential consequences. And that may be necessary because there are certain things that are unavoidable. Or if they are not unavoidable, then the cost of mitigation could be too high. So those are areas, ways in which risks can be treated or mitigated. Avoiding, reducing, transferring, retaining. There are times when one may just accept the risk, one may accept the potential consequences because of unavoidable situations or circumstances. So because the cost of mitigation could be too high. And it's important, candidates, to remember that personal risk management is not about eliminating all risks, but rather preparing for the risk in a way that minimizes their impact and allows you to navigate life's challenges with confidence. The goal here is not to eliminate risks. It's not possible to mitigate against all risks. But the idea is preparing for them. Personal risk management helps an individual to prepare the risk, because remember we have said the first thing you do is to identify the risks, then you assess the risk, you prioritize the risk, then you put in place measures to reduce the impact of the risk on your life. Personal risk management. Let's now discuss the benefits. Benefits. What are the benefits? Benefits of personal risk management. Benefits of personal risk management. And candidates implementing personal risk management offer several significant benefits that can contribute to overall financial stability and peace of mind. The first benefit is financial security. Financial security. Personal risk management can guarantee financial security through protection against losses. You can say protection against losses. Protection against losses or against loss. Personal risk management helps safeguard against unexpected events like accidents, illness, or natural disasters that could otherwise lead to significant financial loss. Through personal risk management, one can insure assets like houses, all right? So that in the event of a loss or burglary, then the individual is indemnified. So when that happens, then you can see an individual's assets are protected through personal risk management. It can also lead to reduced financial impact. Reduced financial impact. You reduce the financial impact of these losses or risks by having appropriate insurance coverage, by having emergency funds in place. Individuals can minimize the financial impact of unseen circumstances such as medical bills, such as property damage, or even loss of income. Retirement planning. Retirement planning. Effective risk management ensures that long-term financial goals like retirement planning are not jeopardized due to unexpected events or due to insufficient funds or savings. Estate preservation is yet another benefit of PRFM. Estate preservation. Through risk management strategies such as estate planning and proper insurance coverage, individuals can protect their assets and also ensure that their assets are passed on to beneficiaries according to their wishes or according to their will. Estate preservation. Another obvious benefit of PRFM is reduced stress. Reduced stress. Having contingencies in place alleviates stress that is associated with potential financial loss or crisis, and it provides a sense of security and allows individuals to focus on other aspects of life without constant worry about financial risks. When you have, for instance, an emergency fund in place, if you have an emergency fund, the way we discussed in our last lesson, that is advisable that one has an emergency fund that is adequate to cover an individual's expenses up to a period of 6 months or 4 months. When you know that you have a fund that can pay for your expenses, even if you lost your job today for a period of 1 year or 2 years or 6 months, then your stress is reduced. But if you are in, say, salaried employment and you have zero savings, the fear of losing a job can lead to stress that may be associated with loss of employment. So PRFM reduces individuals' stress. Having contingencies in place, like a emergency fund, having savings, alleviates the stress that is associated with financial crisis. Do you understand? 5, 6, informed choices. Informed choices. Understanding the potential risks. Understanding potential risks, candidates, because we said the first thing is to identify the risks. So when an individual understands his or her potential risks, that allows for informed decision making. Why? Because it enables these individuals to choose appropriate insurance coverage, appropriate investment strategies, and appropriate financial plans tailored to their specific circumstances. Informed choices. Number 7, emergency readiness. With emergency funds and suitable insurance coverage, individuals are better equipped to handle unexpected situations without resorting to high interest loans or without tapping into retirement savings. Because emergencies in life are inevitable, they are unavoidable. And through personal risk management, individuals can put in place emergency funds, can have insurance coverage, and with that, individuals are better equipped to handle unexpected situations, courtesy of personal risk management. Another point, EFGH, is adaptability to life challenges. Adaptability to life challenges. Risk management, candidates, ensures readiness for life changes. Because here we said that one key aspect of personal risk management is risk identification. You identify the potential risks, your potential risks. You measure the potential risks. Then put in place strategies to address these risks. So through personal risk management, individuals can adapt to changes in life, like marriage. Another change could be having children, career shifts, and so on. So personal risk management ensures individuals are ready for life changes and thereby reducing the financial impact of such transitions. When one gets married, that is a shift in life. It's a change in life, and it comes at a certain cost. But if an individual had anticipated that during this year I'll get married, the individual may put in place measures to ensure that that transition is done with reduced financial impact. Adaptability to life challenges or changes. Let me say changes, are not challenges, but just changes. HI. Another benefit of PRM, personal risk management, is mitigated losses. Mitigated losses. Adequate risk management helps prevent or minimize financial losses, potentially saving significant amounts of money in the long run. Mitigated losses. Another point is optimize insurance costs. Optimize insurance costs. How is this a benefit? It's a benefit because understanding one's risks allows for tailored insurance coverage, avoiding overinsurance or underinsurance, which could lead to unnecessary expenses or adequate protection. Financial stability is yet another benefit associated with personal risk management. Financial stability. By mitigating risk, individuals can maintain a stable financial foundation, which positively impacts overall well-being, reducing anxiety, and promoting healthier lifestyle. When one is financially stable as a result of personal risk management, then one does not have anxiety. Okay, one does not have anxiety. One is at peace, and the overall quality of such an individual is improved. One has a healthier lifestyle. All right. So this is IJK, financial stability. Then lastly, we can mention legacy protection. This is yet another benefit associated with personal risk management. Legacy protection. Proper risk management ensures that an individual's legacy and an individual's financial resources are preserved and can be passed on, or they can be passed down to future generations according to their intentions, or according to their will, or according to their wish. So these are the benefits associated with personal risk management. Now, candidates, in essence, personal risk management empowers individuals to proactively protect themselves and their families against unforeseen financial challenges, fostering greater financial stability and a more secure future. So that marks the end of the lesson, where we've discussed personal risk management. We've identified the key aspects. We've defined personal risk management. Then we have outlined benefits of personal risk management. One is protection against losses. Number two, reduced financial impact. Number three, retirement planning. Number four, estate preservation. Number five, reduced stress. Number six, informed decisions. Number seven, emergency readiness. Number 8, adaptability to life changes. Number 9, mitigated losses. Number 10, optimize insurance costs. Number 11, it leads to financial stability. And lastly, it secures a legacy, protects the legacy of an individual. I'll give you a today's assignment. I have 3 questions for you here. Number 1, what are the key types of risks individuals face in their personal lives, and how can risk management strategies such as insurance help mitigate the potential financial impact of these risks? Number 2, how does an individual's age, health status, and family situation influence the choice and amount of insurance coverage needed for effective risk management? Then lastly, number 3, in what ways can individuals strike a balance between risk-taking for potential financial gains and the need to protect themselves against unseen, unforeseen events through risk management tools? These are 3 questions. Thank you for attending the lessons. Bye-bye.